Hey guys, I hope you guys are blessed and well. So today we are going to cover chapter 13, which is all about measuring the performance of the economy. Right. So for this chapter, we are focusing on the macroeconomics, right? You'll remember that in the first semester, we were just looking at microeconomics, which is basically just the study of the behavior of individuals and firms, right? We're looking at demand and supply, quantity demanded and quantity supplied, right? But now since we are looking at since the study is in the economy as a whole, which is macroeconomics, we are going to be focusing on aggregate demand and aggregate supply, right? Aggregate for total. So now we're focusing on the total demand and total supply because we're studying the economy as a whole, right? The the participants that we are going to be focusing on is no longer just the households and the firms, but it's also the government as well and the foreign sector. Because remember, in the economy, we also interact with the foreign sector through export and import, right? So, yeah. Okay, let me just remove this. So the lecture outcomes. Once you have studied this chapter, you should be able to distinguish between microeconomics and macroeconomics. You must explain the five main macroeconomic objectives and discuss the South African macroeconomy. You must understand the uses of national income accounts, define GDP and how it is measured or calculated. Apply the three methods of calculating GDP, which is your income approach, expenditure approach, and production or value added. Must also be able to distinguish between real GDP and nominal GDP. Discuss whether GDP is a good measure of economic well-being. You must also be able to explain the Lorenz curve and the Gini coefficient. Right, so what is macroeconomics? So I've already explained this, but I'm going to explain it again. So let's just look at the bullet number 3. It says the difference between microeconomics and macroeconomics is an I and A. So micro has an I, so this I for what? For individual, right? And macro has an A, this A for what? For aggregate. So what this means is basically that in microeconomics, the difference is that in microeconomics, where it's basically studying the behavior of what of individuals, right? Remember, I said that in first semester we're just looking at the households and the firms and their interaction through demand and supply, right? That is what we are studying in microeconomics. And then macroeconomics now, it's the study of the economy as a whole, right? Of the economy as a whole. And then A for aggregate, I did say the aggregate means total. So we're going to be focusing on total production, total output, right? Total demand, total supply, because we're studying what the economy as a whole. They said here in the first point, it is the study of economic aggregate or the big picture. Example is the study of the economy as a whole, right? We're looking at the economic activities. Thus, with macroeconomics, we deal with the national economic goals, right? Economic goals such as total output. This can also be total production or aggregate output. It's basically the same thing. We're focusing on economic growth, total employment, inflation, balance of payment, trade deficit, distribution of income, and economic growth, right? These are things that affect everyone in the economy. Hence, now we are going to be studying what the economy as a whole. Right, I hope you guys get that. With macroeconomics, it's the study of the economy as a whole, and micro is the study of the behavior of individuals in the economy. So why do we study macroeconomics? So we study macroeconomics to measure the health of the whole economy. And we measure the health of the economy in terms of the five macroeconomic objective, right? The five macroeconomic objectives are economic growth, right? Which is basically an increase in the total production Economic growth is just an increase in the total production or an increase in the rate of real GDP. I'm going to explain this when we actually get to when I explain the five macroeconomic objective in detail in the next slide. And then also full employment is one of the macroeconomic objective. It is also used to measure the health of the economy. Um, and they're always trying to make sure that the unemployment rate is as low as possible, right? So if the unemployment rate is low, it means that the economy is doing well. So and then the price stability as well, one of the macroeconomic objective, which is price stability, speaks of inflation, trying to keep the inflation rate low or between the inflation targeting of 3% and 6%. We're also going to discuss this when we get there. Also, the balance of payment. The balance of payment is just an account which records all transactions between the economic um between the residents of this country as well as um sorry, it records all transactions between us with the rest of the world, right? Through exports and imports, like our interaction with the rest of the world, like when you buy from Shein and also when they buy from us, and also when we invest in other countries and also when they invest in our country, right? The balance of payment, it just records transactions between um our citizens with the rest of the world, right? And then equitable distribution of income is just, it is all about ensuring that income is equally distributed. It's one of the macroeconomic objective, which is equitable distribution of income, which just tells about ensuring that income is equally distributed between the rich and the poor. So basically, they're trying to make to ensure that there's no high gap between the rich and the poor, right? There's no huge gap between the rich and the poor by doing what? By equally distributing income, right? So number two, why we study economics to guide government policies. So to make sure that government policies are properly implemented, right? Also to assess the quality and effectiveness of government policies. So now, once they have those policies, they want to ensure that they are effective, right? The government policies are effective. And then also number four, macroeconomic affects society's well-being. We study macroeconomics because it affects society's well-being. For example, if we have a higher rate of unemployment, it means that many people are not employed, right? So that how can that affect the society? Can affect the society through crime. The crime rate will increase because people will be trying to find means to survive, right? And also teenage pregnancy and so on. So macroeconomics also affects the society's well-being. I hope you guys understood that. So why measure the economy? In the past, the South African national accounts were compiled by Statistics SA and the South African Reserve Bank. But now the function has exclusively been performed by the State SA. So basically here they're just telling us that um, the national accounts are complied by the Statistics South Africa. They're the ones that compile the national accounts. Right. So now we five macroeconomic objective. So now we're going to be looking at the macroeconomic objectives. There are five of them, which is economic growth. Remember, I did say, Guti, economic growth is basically just the increase in the production, right? It's basically the increase in the production, which is an increase in the rate of real GDP, right? So the first step to determine gross domestic product, which is GDP, you have to be able to define GDP. And they gave us a definition here to say GDP is the market value of all final, let me use my cursor, is the market value of all final goods and services produced within the boundaries of a country in a given period of time, usually a year. So GDP, um, it's the gross domestic product. It is the market value, meaning that it is measured in monetary terms. right, of all final goods. So final goods is telling us that they measure all the final goods that have been produced, not intermediate goods. Remember, we have final goods and we also have intermediate goods, right? So in calculating GDP, they only include the final goods. For example, let's take flour. Flour, when I buy flour from ShopRite, to me it's a final good because I'm gonna buy it and then use it not to resell, but just for consumption, right? But if you're buying flour and you're going to use it to bake cake and then sell cake as the final product, so in calculating GDP, we will then for you we will not add flour at the first stage when you're actually purchasing it to use it in the production process of baking cake, but we only calculate the final product, which is basically what the cake. So final goods means that we do not add any intermediate goods, but we only include what the final goods which have been purchased for consumption, but not for resale or for to be used in the production process as inputs. Right? Do you get that? I'm not sure if my example made sense, but final goods, just the goods that you purchase for consumption, not to sell them or to use them in the production process, right? Okay, and then they say within the boundaries of a country. So these goods have to be produced within South Africa, right? To calculate GDP, we only include the goods that have been produced within the boundaries of the country, right? Within South Africa in a given period of time, which is usually a year, right? So GDP is just the market value of all final goods produced within the boundaries of a country in a given period of time, which is usually what's a year. And then now economic growth, it is the rate at which the nation's real GDP changes or grows from year to another. So economic growth is basically just an increase in the production or an increase in real GDP. Okay, so how does economic growth um come about or yeah, come about? Okay, so let me just give this example. So let's say okay, remember I said economic growth is an increase in the production, right? In the production, which is an increase in real GDP. So if there's an increase in the production of goods and services, so let me just start from GDP. So if GDP is increasing, which is basically the goods and services which have been produced within the boundaries of the country, if they are increasing those goods that have been produced, what does that tell you? Right, it tells us that they were more factors of production were employed, right? More factors of production were employed in order to increase GDP, right? It's because GDP cannot just increase. Something must have happened. So in the production process, they employed more factors of production. The factors of production are what? It's land, labor, capital, and entrepreneurship, right? But for this example, let's just focus on labor. Okay, so now it means that more people, more workers were employed in the production process in order to increase what? Our GDP, which is basically just the production, which is just the output, right? So more people were employed to increase this output. So if more people are being employed, what is happening to the rate of unemployment? The unemployment rate is doing what? It's going to decrease, obviously, because more people have been employed, right? And then now when these people have been employed, they're going to do what? They're going to earn income, right? From supplying their labor, from working and producing this output. They're going to earn income. And then when they earn income, the government obviously is going to charge tax on their salaries and wages, right? So they're going to pay tax to the government, right? They're contributing now in the economy. So they're going to pay tax to the government. Now, when they pay tax to the government will use that tax to do what? To provide us with the public goods and services, right? I hope you guys are following. And then when the government provide us with the public goods and services, okay, no, public goods and services such as what? the government will provide us with schools, hospitals, infrastructure, better roads, and what else? Okay, and so on. So the government, okay, RDP houses, the government provides us with those public goods and services. So what does these public goods and services do to us? They improve our standard of living, right? And then that is how economic growth comes about. Obviously, now when our standard of living has improved, when the production in the economy is increasing, then that will lead what to economic growth, right? So that is why I just hope I didn't confuse anyone. That is why we say here, we'll see economic growth is an increase in the production, which is an increase in real GDP because it start there. It start from an increase in the production, which will then increase these other things, right? And later improve even our standard of living because now the production has increased, more people are employed, the government can also provide us with the public goods and so on. And this was all through us, just through an increase, and this all occurred because of an increase in the production, right? An increase in the output which was produced. I just hope you guys got that. Okay, let's continue. So economic growth is just an increase in the production or an increase in real GDP. The nominal GDP is GDP which is calculated using the prevailing market price or the current price. Nominal GDP, you can find it can also be called GDP at current prices or GDP at market prices. This is where now we calculate GDP using the current market price, right? And then for real GDP here also called GDP at constant prices, right? We calculate GDP using the prices of the base year, right? And the prices here, they've been adjusted for inflation when you're calculating what? Real GDP. Right. That's the only thing you have to know here. You have to know that for nominal GDP, you use the current prices or the market prices. And then for real GDP, you use the prices of the base year. To calculate real GDP, use the prices of the base year. And real GDP eliminates what's inflation because for real GDP, when you're calculating real GDP, we do not use the current market price, but we use the prices of the base year to try and eliminate what's inflation, right? So I'm not gonna focus more on that. And then now a second macroeconomic objective is full employment, right? What is unemployment? Unemployment is basically a situation where people are actively looking for jobs, but they cannot find employment. So to be unemployed, you have to be actively looking. You have to be willing and able to work, right? You don't have to be someone who has a degree and just sitting at home, but you have to be a person who has a degree but is actively looking for employment. Then we can say to you are unemployed, right? So we have different types of unemployment. We have structural unemployment, we have seasonal, we have frictional and cyclical. We are going to do these in the next chapters, but structural unemployment, this one is structured. You can see it occurs because there's a mismatch of skills. So let's say you are a graduate, you have your degree maybe, and you are a qualified accountant, right? And then you find Uti, maybe there are space of there's a job which is available for teaching or for what? Yeah, but then like the job which is available, it does not match the skills that you have or the qualifications that you have. So you find Uti, P- um there's a job available for teaching, but when your degree is you are a qualified CA, so obviously you can't take this job because there's a mismatch of skills, right? The skills which are needed, um, you don't have the skills which is needed at that time, right? So we said Ukuthi that is structural unemployment. We also have seasonal unemployment. Seasonal unemployment, it occurs basically in certain seasons. Some people they only get employed during December. Some people only get employed during Easter, you know. Yeah. And then frictional unemployment. this is unemployment that occurs because people they are moving in and out of jobs. It can be because they are looking for better opportunities or your contract expires, so now you need to find another job, right? And then cyclical unemployment, this one occurs when the economy is in a recession. You'll see this when you're doing the business cycles. Sometimes the economy can be in a recession. That is where the unemployment rate is high. The things are basically not doing well in the economy, right? People they get retrenched during the recession, right? And then macroeconomic, okay, no, unemployment, okay. They're explaining the same thing here. They're saying that it is an economic phenomenon in which a person who is actively looking for employment is unable to find work. So if you are unemployed, you are actively looking, but you are unable to find work. The unemployment rate is the number of people as a percentage of the total labor force. So to calculate the unemployment rate, you say unemployed people divided by the labor force, right? Then you get the rate, the rate of unemployment, right? So it's the people that are actively looking for jobs, the unemployed, divided by the labor force, those ones that are working, that are worth jobs. So there are four types of unemployment. Okay, I've already explained these. And then calculations of unemployment rates, the socioeconomic effects of and the remedial policies for unemployment to be covered. Okay, no. So you guys, you get it, you get the slide, right? Unemployment, if you're unemployed, you are actively looking for work. You are willing and you are able to work, right? And then to calculate the unemployment rate, we say people who are unemployed divided by the people who are employed, right? Also called the labor force. And then price stability, the third macroeconomic objective is price stability, which is inflation. And then they ask, what is inflation? So inflation is basically just the continuous. The key word it has to be continuous. So it's a continuous increase in the prices of goods and services. Right. So if the price of goods and services they keep on increasing, then we said we are experiencing what? Inflation. Right. Let's just go to the slide. So it is a process of rising in prices. The inflation rate is measured as a percentage change in the average level of prices or the price level. It is a change in the consumer price index. We'll do this one, the consumer price index in the next chapters. But like what you have to know in regards to the consumer price index is that the the consumer price index is used to measure the changes in the price of a market basket, right? So the market basket is just consists of goods that households usually buy, right? And then now this is done by Stats SA, Statistics South Africa, to measure the market basket, which consists of the goods that consumers normally buy, right? And then if they are now measuring the changes in the price of the market basket, they are basically um to do that, they use the consumer price index, right? I think what is the formula? Yeah, I've forgotten the formula, but we are going to do this in the next chapters. So for now, we just have to know that the consumer price index is used to measure the changes in the price of the market basket, right? Which basically consists of goods that consumers usually buy. So Stats SA will just do their own survey and then determine the goods that we normally buy as consumers, right? And then take those goods and then now measure the changes in the prices of those goods, right? To calculate what the CPI. And then inflation must always range between 3% and 6%, right? That is the inflation targets range in South Africa. It's 3% and 6%. We also have what we call hyperinflation. Hyperinflation is an extreme form of inflation, right? This one is hyper. So it's an extreme form of inflation where now the inflation rate increases an inflation rate of 50% per month, right? That is what hyperinflation. So for this slide, you just have to be able to define what inflation is, and also um, which is basically a continuous increase in the prices of goods and services. And then hyperinflation, it's the extreme form of inflation. And the inflation must always range between the inflation targets of 3% and 6%. So they're basically showing us the hyperinflation here in Zimbabwe, where you had to spend a lot of money. You can see this person is carrying a lot of money. Probably he's just going to buy bread, right? Because the prices were too high. Because hyperinflation, remember we said it's an extreme form of inflation. And also here, okay, the fourth macroeconomic objective is the balance of payment, which is the external stability, right? So the balance of payment, I dare say, Guti, it's an account that record all international financial transaction made by a country's residents with the rest of the world, right? It basically records all the transactions with the country's residents and the rest of the world, right? So if whatever we do when we are basically our interaction with the rest of the world, obviously valid through exports and imports, right? Because that's how we interact with the rest of the world, and also through foreign direct investment and portfolio investment, right? So the balance of payment consists of two accounts, which is the current account and the trade account. Oh, sorry, which is the current account or the trade account and the financial account, right? So the current account or the trade account, it just records all sales of goods and services, right? So current account or the trade account, it just records all the sales of goods and services to the rest of the world and all the purchases of goods and services from the rest of the world, right? So really, how do we interact with the rest of the world? Through exports and imports. So now if the current account records all sales of goods and services, it's obviously through what? Exports and imports, because that's how we interact with the rest of the world. We interact with them via exports and imports. So exports, those that is where now we are selling to the US, for example. Imports, that is where now we are buying from them, right? So goods are coming in, imports, and exports, goods are going out. We are selling to them, right? So if we have a trade surplus now, it means that the exports are greater than what? The imports, meaning that what we sold is greater than what we bought, right? So we'd have what's a trade surplus. Obviously, this makes sense because when we are selling, money is coming in. So income, I'm just going to say, okay, I'm going to refer it to as income. So we are selling, money is coming in, that's income. And imports, we are buying, money is going out, that's an expense. So our income are greater than what's our expenses. Obviously, that is what's a trade surplus, right? And or net exports is greater than zero. Net exports, you get it by saying exports minus imports, right? So income, because exports we are selling goods to them, they pay us, so that's an income to us. And then imports, we are buying from them, we are paying, so that's an expense. So if you say income minus expense, you get net exports, right? If you say exports minus imports, you get net exports. And if your net exports are greater than zero, it means we are in a trade, we have a trade what? Surplus, right? Also now, if our exports are less than imports or net exports are less than zero, it means we have a what? A trade deficit, right? So here we have our expenses are greater than our income, because I remember I said with exports, that is when we are selling to the US, for example. So if we're selling to them, they would pay for those goods, which would be an income, right? And here we are buying from them, so we will pay them money, which will be an expense to us. So if our expenses now, what we are buying from them is we are buying more than they are actually buying from us, would have a trade deficit because our income would be less than our what? Sorry. yes, will be less than our expenses, right? So the net exports is less than zero. We have what? A trade deficit. Right. So the balance of payment it's record all international transaction made by a country's residents with the rest of the world. And it consists of two accounts, which is the current account or the trade account. And in the current account, it's where we record our money. It's where we keep records of all sales of goods and services. Right. Um, of all sales of goods and services when we are based and how do we interact with the other country? In terms of farmer sales and like purchases, it's through exports and imports, right? So the current account, we're recording basically our exports and imports when we are buying from them and we are selling from them. Then we also have the financial account. Remember, I said we have two accounts in the balance of payment, which is the trade account or the current account and the financial account. So in the financial account, it records all international transaction in assets and in liabilities. So basically, in the financial account, it records all interactions um, with the rest of the countries when we are purchasing assets and liabilities when we are maybe through our loans and borrowings, right? So the financial account has three main components, which is the direct investment. Direct investment is basically where now a person from the US would come to South Africa and open a business that is direct investment, or they can invest in monetary terms, right? That is direct investment. And then portfolio investment, it's basically now where a person from South Africa will then invest in the US, right? Or yeah, will invest in the US through bonds and shares, right? One of our lecture made an example to say that Motsepe can buy shares from Manchester United. I'm not sure if I'm saying that correct, but can buy shares from Manchester United, right? So that is what portfolio investment. He's in SA, but he has shares in a business which is in the US, right? And other investment as well. So, okay. So also with the financial account, we can have a surplus or a deficit, right? We can have a surplus that will occur when the inflows are greater than the outflows, meaning that um the people from the US coming to invest in us in SA, the investment from the US is greater than the investment um than our investment in the US, right? Does it make sense? So the investment from the US, so them coming to invest in us, which is the inflow, right, is greater than our investment in the US. So us investing that side, right? Investing that side. It's our investment is less than their investment. Then excuse me, then we have what? A surplus, right? Are you guys getting that? So there's a net capital inflow, meaning that people in other countries they're interested in investing in us, right? There's an inflow in foreign direct investment, right? And then when we have a deficit, that's when now their investment in us is less than our invest. So most people in SA are investing in businesses that are not in SA. They are investing in, how can I put this? They are investing in other countries. They are buying shares in the US. They are buying bonds in the US, while the people in the US, they are not investing in South Africa, right? There are no inflows of foreign direct investment, right? So if the inflows are less than the outflows, then we would have what? A deficit. That is the net capital outflow. So I hope you guys are getting this one as well. So the financial account, it just records all international transaction. transactions and assets and liabilities. Assets basically now we are purchasing capital goods. Liabilities, we are through our loans and borrowings. So the financial account has three components, which are direct investment, meaning that a person in the US is investing in SA. For example, a person may come from the US and open a business here in South Africa, right? That is direct investment. Portfolio investment, that is now where we go and invest that side, right? So where Patrick Motsepe would buy shares from Manchester United, right? That portfolio investment. So now if now the inflows is greater than the outflows, it means that we have what? A surplus, because it means that the more people are investing in us than we're actually investing in them, right? So that we have what? A surplus. And then a deficit is when now the inflows are less than the outflows, meaning that what, okay, let me just make this example. So what Patrick Motsepe invested here is greater than what the maybe, let's say another business comes to another firm from the US is opened here in South Africa, right? That is direct investment. But then what that firm is actually making, for example, is less than what Patrick Motsepe invested in the US. Is less than, yeah. I feel like I'm confusing you guys. Okay, so let's just stop there. So when you add the current account balance plus the foreign account balance, you get the balance of payment balance, right? So the current account, remember, it's where we interact with the rest of the world through our exports and imports, selling and purchasing. And then for financial accounts is through assets and liabilities, where we have direct investment as well as portfolio investment and other investment as well. So you must be careful when you find maybe like MCQ question and they say with you, um is it a, okay, I don't know how they put this question, but do you see the difference with this one? You would have a surplus if the inflows are greater than the outflows, right? Or the net capital, where we have net capital inflows, right? There would be a surplus, but then there'd be a deficit if the inflows are less than the outflows. So if the question is it has exports and imports, then that speaks to what? To the current account. But if it has AMA inflows and outflows, that is referring to what? To the financial accounts. That's what I was trying to say. So if you add the current account balance plus the for financial account balance, you get the balance of payment balance. We also have ways to correct the trade deficits. Okay, let's say now we have a trade deficit there in our BOP, right? In our balance of payment. So how are we going to correct that trade deficit? Through what? Through import controls. So import controls are things such as your import quotas or your tariffs, right? Import quotas, that is what? It is a limit in the number of goods that can be what's imported. So the government will say that if you want to buy from Shen, you can only buy 3 items, right? That is an import quotas, where the government limits the quantities of goods that can be that can be imported. We are doing this to do what's available, to try and correct the trade deficit. Remember, when we have a trade deficit, it means that our imports are greater than our exports, right? So we want to correct this by increasing our exports. So discouraging, so through import quotas, the government discourages imports in order to try and increase what's exports, so that to fix this trade deficit, right? And also through our tariffs. Tariff is like a tax on imported goods, right? So if you are buying things from like from Shein, you are then charged an extra amount, right? So you'll be discouraged to buy those goods Because if you do your calculations correctly, you will see that yes, the same price I'm paying for these products is the same amount I was going to pay if I had bought this thing from Mr. Price, right? So you end up being discouraged to import and end up buying from the local producers, right? And then import substitution, another way to correct trade deficits. Import substitution now is basically where the government will say, ukuthi, let us help the local producers to produce these products that people are actually importing from outside, right? So let's say we are importing, what can I say? Okay, no, let's just say we are importing this particular product from outside. So the government will say, it's okay, and then maybe there is a local producer in South Africa who's producing that same thing, but is not as good as the one that we are actually importing, right? So the government will try to help this local producer to help the local producer by providing the him with maybe incentives or giving him tax rebates to ensure that he can be able to increase and improve his products, right? And then now we can actually buy from him and not import that particular product, right? So I hope you guys are getting that one. Import substitution is like let's try to make these products here in South Africa and not import it, right? So it's they're saying here local production of imported products for self-reliance. Because remember, we're trying to correct the trade deficit, so we have to reduce imports and increase what? Exports. And then also we have exchange rates devaluation. Exchange rate devaluation is basically now it's a deliberate decrease in the value of our currency in terms of another currency, right? So that is where the government will like decrease the value of our currency in terms of another currency that we are trading, in terms of the currency of another country that we are trading with, right? Let's say most people are buying from China, right? So now the government is trying to do what to correct the trade deficit. So they want to discourage imports, right? So they will devalue the value of the rand against China so that it becomes expensive for us to buy from them, right? But then if that happens also, it becomes cheaper for them to buy from us because the value of our currency has depreciated, right? So it becomes cheaper for them to buy from us, which will increase our exports. And which is what we want really because we want to correct the trade deficit, want to increase our exports. And it will be difficult for us, it will be expensive for us to buy from them because the value of our currency has been what? Devalued, has been um deliberately deliberately reduced, right? So exchange rate devaluation is just a deliberate um decrease in the value of our currency in terms of another country's currency. So we're saying here the downside is that it could result in high inflation via high import prices. Obviously, it becomes very expensive for us to buy things from outside. And then we also have export promotion. Export promotion is the government may provide credits and incentive and tax concession to exporters. So this is where now the government is trying to increase our exports. Remember, we have a trade deficit, right? Meaning that our imports are greater than our exports. So to correct this trade deficit, we have to encourage in exports, right? So the government will do what we call export promotion by providing credits. So let's say a person from the US wants to purchase something here in SA. The government will allow that person to purchase that particular product on what? On credits in order to increase our exports. Or can provide our incentive or tax concession, right? Tax concession, it's basically like a reduction in the tax for certain individuals, right? So the government will reduce the their taxes that they are going to pay so that they can be encouraged to purchase things from us, right? That is export promotion, right? Basically, we now the government will allow people that are buying from us to buy on credit, or can you reduce their taxes in order to encourage what? To encourage exports. And then you also have macroeconomic objective four. No, I think I went backward. Okay, number five, equitable distribution of income, right? Equitable distribution of income, this is basically now where we are trying to reduce the gap between the rich and the poor, right? By equally distributing income, by distributing income equally, right? Income inequality, it refers to an extent to which income is distributed unevenly among individuals or households. So income inequality, there's income inequality when the income is not distributed evenly amongst the individuals or households, right? South Africa has one of the most unequal distribution of income in the world. So we measure the income inequality using the three measures, which is the Lorenz curve, the Gini coefficient, and the quantile ratio. Right. So this is the Lorenz curve. This is how the Lorenz curve looks like. And the Lorenz curve, it just illustrates the degree of inequality in the distribution of income. Right. Yeah, basically with this one, you just have to know the definition and also know to get this line here, we call it the line of equality, right? Or perfectly um equal distribution of income. It shows that income is distributed equally, right? Or I just call it the line of equality. And then this gap here is called the area of inequality, right? So this line is the line of equality, which shows perfectly equal distribution of income. And then this gap here is called the area of inequality. So now this one is the Lorenz curve. So if this curve here is further away from the line of equality, so let's say this curve is here. Okay, let me just try. So if this curve is here, it is further away from what is going on? Maybe it's going like this. Okay, it shouldn't be outside the this one, the vertical, the horizontal line. Okay, let me just let's say the Lorentz curve is here. You see AY, guys. It is further away from the line of equality. So now this is telling you that there's a what? There's a greater degree of inequality, right? But if the Lorentz curve is here, is closer to the line of equality, you can see the gap of inequality is small, right? Compared to when the curve is here. So this one shows you there's a lower degree of what of inequality. As much as there is an unequal distribution of income, but it's not as greater as when the Lorenz curve is here, right? I think that is all you have to know in regards to this graph. That this one is the line of equality, and then the area here is the area of inequality, and this is the Lorenz curve. So if the Lorenz curve is further away from the line of equality, it means that there's a higher degree of inequality. But if it is closer to the line of equality, it means there is lower degree of inequality. And then you also have the Gini coefficient. The Gini coefficient, you just have to be able to calculate it, right? You calculate it by saying that the area of inequality, this one, the area of inequality, this area here, the area of inequality divided by this whole area here, this one, the triangle. So that's how you calculate the Gini coefficient. You say the area of inequality, this one here, 0B, DCBA, this area here, divided by BAO. right? You get the Gini coefficient. And then when you calculate the Gini coefficient, it's supposed to, when it will vary between 0 and 1, right? It's the answer that you get between 0 and 1. So if your answer is closer to 0, maybe it's 0.4 and below, it means that there's a low degree of inequality, right? But if the answer you get is 0.7 and above, right, or 1, excuse me, you just have to know what this line is for what, and then also be able to calculate the Gini coefficient, and also now be able to interpret the answer that you get. So if it's 0.4 and below, it means there's a low degree of inequality. But then if it's 0.6 and above, and then it means there's a high degree of inequality, right? Then also you must be able to calculate the Gini index using the Gini coefficient. So you take the answer you get from calculating the Gini coefficient, you multiply by 100, you get the Gini index. Then you also have the quantile ratio. Also with this one, you just need to be able to you just know the formula basically and calculate it. You say income received by the highest percent of the population divided by income received by the lowest percent of the population. Right. And then, oh, here they give us, you see here, they're saying that the Gini coefficient is 0.63. So what is this telling you guys? How is income distributed? Is there a low degree of inequality in terms of the distribution of income, or is there a high degree of inequality in the distribution of income? Correct. There's a high degree of inequality in the distribution of income because 0.6 is closer to 1, right? Remember, I said that your answer will vary between 0 to 1, right? So if it's 0.6 and above, it means there's a high degree of inequality in the distribution of income. But if it's 0.4 going down, it means there's a low degree of inequality in the distribution of income. So let's do these questions quickly. Macroeconomics is a branch of economics that studies. So macroeconomics, remember we said we look at A, and A is telling us to aggregate, right? A for aggregate, so total demand, total supply. And we said we are basically looking at the aggregate economic activities, meaning that the total economic activities, right? We're studying the economy as a whole. So number A is saying that the determination of total economic activities, A is correct. B, the behavior of individual, no, this one will be micro. The effects of and consequences of aggregate behavior of all decision-making units, yes. So the answer is A and C. A and C. Which of the following does not represent a key macroeconomic variable? Mhm. So they're saying both inflation and unemployment. No, these are macroeconomic variable because inflation affects everyone in the economy as well as unemployment. Income distribution, yes. Economic growth, yes. Population growth rate, no. So the correct answer here is D because it does not represent the key macroeconomic variable, right? And we didn't say anything about population growth rates. So D is the correct answer. And then since 2016, the South African national accounts are compiled by, you guys know this one, yeah. Yeah, I think you guys are correct. It's C, Statistics South Africa. Because remember, it was Stats SA and the South African Reserve Bank, right? But from 2016, the rights was just given only to the Statistics South Africa. So it's just have been it since 2016, it just has been them who are complying the national account, right? And then number four, the market value of all final goods and services produced in a country during a particular year is called, you guys know this one as well. The market value, yeah, it's GDP. So the answer here is B. If there is a deficit on a country's current account, it means that during that period, remember, guys, they're saying in the country's current account, right? Remember, we have current account and also have financial account, right? With the current account or the trade account, that is where we say, Uti, we look at the sales and the purchases of goods and services with us and the rest of the world, right? And how do we interact with the rest of the world through exports and imports, right? So for current account, you will not look at the answer which has inflows. and foreign capital inflows. You're going to look at those answers which have imports and exports, right? So your correct answer is between A and B, right? Because it's the current account. If it was the financial account, so you see here, they are referring to the financial account. The financial account, that is where we said, we look at things such as direct investment and portfolio investment, right? So where we look at our net inflows and net outflows, right? What is coming into the country and what are we investing in other countries, right? So if now you are asked to, what are they saying here? If a country's financial accounts is in a surplus, it means that during that period under review. So the answers here, your options that you must look at here are the ones that have inflows and outflows. So these two, they are out, right? They're already out because financial accounts, um we do not include any exports and imports, like the sales of goods and services. No. Here is just the di the direct investment as well as portfolio investment, right? So let's go back to this one again, number five, saying that if there's a deficit on the country's current account, it means that during that period, so if there's a deficit, obviously it means we would see um our imports are greater than our exports, right? So remember I said with imports is us buying from them, so money that is going out. So this is an expense, and then exports, it's us um it's us selling to the rest of the world. So money is coming in. So this is an income. So we would have a deficit if our income is less than what's our expenses, meaning that if our expenses are greater than our income, right? So number A is the correct answer here. Yeah, number A is the correct answer. I just wanted to confirm that. And then number six, if a country's financial account is in surplus, it means that during a period under review, so now we are in a surplus, right? So we have inflows and outflows, right? Remember I used an example of Patrice Motsepe investing, buying shares in Manchester United. That is an outflow, right? Because he's buying shares from that side. And then if a person from the US comes to South Africa and opens a business here, that is an inflow, right? Because they're investing in us, right? So, so now if our inflows, meaning that people coming to invest in us, is greater than our outflows, meaning that us investing in them, then we'd have a what? We'd have a surplus, right? Or if there's an increase in the net inflows, right? Then we have what? A surplus. So let's see. Obviously, A and B is already out. Number C is saying there was a net inflow of foreign capital into the country, right? And then D is saying that capital outflow exceed capital inflow. No, the correct answer is C, because this one is saying that capital outflows, meaning that us investing in them is greater than them investing in us. That would be a deficit, not a surplus. So C is the correct answer in this case. And then which of the following is GDP measured in actual market prices? Sorry, or this one is GDP at market prices, or it can also be called nominal GDP, right? Or GDP at current prices. Oh, I've already given you guys the answer. The answer is C. The answer is C because when we calculate nominal GDP, we use the market prices or current prices, right? And then we also have which of the following is GDP calculated in constant invariant prices? I don't know of this. Invariant prices. So GDP at constant prices is also called real GDP, which is calculated using the base here. So the answer here is what is D. When calculating real GDP, we use what? Constant prices, right? Keep the prices constant. And we use the prices of the base year. And then inflation, inflation is, so it's just, remember I said it's a continuous, right? Continuous increase in the prices of goods and services. So number A is saying a process of rising prices. A could be correct. Process of falling prices, that would be deflation. Minor change in the price level, no. Large one-time increase in the, okay, so the answer here is A. Number D is very confusing. Large one time, okay, one time give it away, one time increase. So the answer here is A. And then occurs when prices decline. So when prices decline, it's deflation, guys, right? So the answer here is C, right? Hyperinf hyperinflation, that is where we said also there's an extreme inflation where there's a 50% increase in the prices per month, remember? So the correct answer for this one is D, it's deflation. It's deflation occurs when there's a decline in the prices. So the prices are decreasing. Which one is not a method for measuring or calculating GDP? Okay, we haven't gotten this to this part, but I think we know this. So we have three methods. We have the income method, the expenditure method, and the production or value-added method. So which one is not? It's basically the GDP deflator approach. GDP deflator, to calculate it, you say, I think you say nominal GDP over real GDP. Okay, nominal confuse you guys. So the correct answer here is C. Number 12, they're saying GDP at prices will usually be greater than GDP at prices because of. So the correct answer at constant prices, no, will usually be greater. GDP at constant prices will not be greater than GDP at current prices, right? Because constant prices, we keep the prices constant. So it's the correct answer here is B, right? GDP at current prices will be greater than GDP at constant prices because of inflation. Remember, current prices, we use the market price. So if you were to calculate GDP, maybe let's say the prices of bread for right now is 20 rand. The price of bread is 20 rand. And the prices of bread back then maybe was 10 rand. And you buy, and then maybe let's say now you have two quantities of bread. So to calculate um current okay, to calculate GDP using the current price, you say 2 times 20 because now the price of bread is 20 rand, right? We're using um the market price, the current market price. So if you say 2 times 20, if the quantities of bread were 2, you would get what? 2 times 20, that's 40, right? And now if you're using constant prices, you're gonna say 2 times the price of bread back in 2010. So I said in 2010, let's say the price of bread was 10 rand. So if you say 2 times 10, I'm gonna get what? 20. So you can see now that using constant prices, the GDP is low because it's 20 compared to when using current prices because we got 40, right? And this is because of what? Of inflation. Current prices take into account what inflation, but constant prices eliminate the effect of what of inflation, right? So the correct answer here would be B. And then exports minus imports equals to net exports. The correct answer here is D. The unemployment rate is, oh my goodness, the unemployment rate, the unemployment rate is so remember, okay, we said it's the number of people who are unemployed divided by the labor force. So the percentage of labor force that is unemployed, the percentage of the population that is unemployed, the total number of people unemployed in the economy. Or they just want the rate. Is the percentage of labor force that is unemployed. So the correct answer here is C. And then let's continue. I just want to charge. Okay, so define GDP. Okay, we've already defined GDP. We said it's the gross domestic product. The gross domestic product is the total value of final goods and services produced within the boundaries of a country in a particular period. So gross means that there's no provision for depreciation or consumption of fixed capital. Value, it is expressed in terms in monetary terms, in terms. And then final goods and services basically means we avoid intermediate goods in order to avoid double counting, right? Because if we add intermediate goods, then it would not reflect it would not be our GDP will not be a true reflection of the total production because let's say now we're calculating GDP and we have this person who buys flour for consumption, and we have this person who buys flour for resale, like to use it in the production process and then sell it as a final product, which is maybe a cake. So if we are counting that flour, okay, in calculating GDP, if we count that flour from the first time when the person is purchasing it, and we also count it again when the person has produced cake, that would be what double counting, right? So if we now we're calculating GDP, we count the flour from the shop to that person to that baker, and then we also count now that cake from the baker to what to the consumer. That would be double counting. So to avoid double counting, we avoid intermediate goods such as what? Such as that flour. We only gonna count it when it is what? It is the final item. Which I don't know if I made sense, but yeah. So here we avoid intermediate goods to avoid double counting. And then geographical aspects within a country's boundaries. So within the boundary of the country, current production. So during a particular period. Just what I explained. So the three methods of calculating GDP, you have the production method, which is the value added method, the expenditure method, and also the income method. So the first approach is the production method or the value added method. Basically now when we are calculating GDP using the value added method, we are only focusing on the value that is added by each participant, right? So they gave this example. I just wanna okay, so there's no where's the scenario? Okay, it's not here. So I'm gonna read the scenario, then we'll look at the at how they calculated here. So this is the production method or the value added. We're only focusing on the value which was added by each participant. So a farmer produces 100 bags of wheat, which he sells to a miller at 10 rand per bag, yielding a total of 10,000, right? So if you say 1,000 times 10, you get what? 10,000, right? So the farmer gets what? 10,000 for producing the bags of wheat, right? So you can see the here, the farmer has the value of sale is 10,000 and the value which is added is 10,000. Then the miller produces, okay, the farmer then sells this to a miller and gets 10,000 obviously for selling this. Then the miller produces the wheat into flour, which he then sells to the baker for 12,500, right? So now the miller will produce the wheat into flour and then sell to the baker, and the baker will pay what? 12,500, right, for that flour. So the value which has been added now is we're gonna say 12,500 minus 10,000, you get what? 2,500. That is the value added, right? By the what? By the miller. And then after baking bread with the flour, the baker sells it to the shop for 18,000, right? So the miller sells the bread to the baker, the flour to the baker, and the baker bakes bread, of which he sells to the shop, and the shop pays 18,000 for the bread, right? So baker gets 18,000. So the value which has been added by the baker, it's 18,000 minus 12,500, which is 5,500, right? And then the shop subsequently sells the bread to the final consumer for 21,000. So when the now the when the bread is they at the shop, me and you we go there as consumers to purchase that bread for 21,000, right? So the shop gets what? 21,000 from the consumer for buying the spread. So the value that has been added by the shopkeeper is 21,000 minus 18,000, which is 3,500. If you add all these amounts, you get 21,000, which is the value added. Right. So this is calculating GDP using what? The production approach or the value added. They're saying that here the amount by which the value of the firm's products exceeds the value of the goods and services the firm purchases from other firms at the stage of production. Okay, so here they're still showing the same calculations basically. And then we also have the second approach, which is the expenditure approach, right? So for expenditure approach, you basically you add all the expenditures by the participants in the economy. So this is consumption expenditure by household, investment by firms through buying capital goods, government expenditure. Then you also have our expenditures in the foreign sector through exports and imports, right? So the expenditure method estimates GDP by adding up all the components of final demand. This is the sum of spending by households, firms, the government, and the foreign sector on final goods and services produced in the domestic SA economy. I don't know this role mean. Or the expenditure approach measures GDP as the sum of consumption expenditure, investment, government purchase of goods and services, and net exports. So expenditure method that we calculate GDP by adding up all the expenditures in the economy by households, by firms, by the government, and our expenditure in the what in the foreign sector through exports and imports. Right. This one is quite easy. The expenditure method. Like it's easy to remember. You just say C plus I plus G plus X minus M. X minus M is also net exports. So don't be confused if maybe you don't see exports and you don't see imports, but you see maybe a figure for net exports, then you just put it here. It's the same thing. So we also have the income method. The income method, it's on calculate GDP by adding up all the incomes received by the factors of production, right? During the stages of production. So our factor of production is land, labor, okay, it's land, capital, labor, and entrepreneurship. And the income they receive, land receives rent, capital receives interest, labor receives wages, and entrepreneurship gets profits. So when you're using the income method, you basically add all the incomes earned by the factors of production, right? And then measurement of market prices, basic prices, and factor cost or income. The three sets of prices that can be used to calculate GDP. So we can calculate GDP at market prices. That is used when we are calculating GDP using the expenditure method, right? And then calculating GDP at basic prices is used when we are calculating GDP using the production method. And then calculating GDP at factor cost is used when we are calculating GDP using the income method, right? So to be able to remember this, you can say that factor cost, right? If they say calculate GDP at factor cost, to know which method to use, just tell yourself, okay, factor cost, this one, okay, factor, and then change this factor and say factors of production. So the factors of production, you know that factors of production, they earn what? They earn income, right? Such as your rent, your interest, your profit, and what else? Your wages and salaries, right? So for factor cost, you use what? The income method because the factor of production, they earn an income. I'm not sure if that is going to help. But also with the market price, you say, okay, market price. Remember, where do you pay the market price? You pay the market price when you go there to the shops to buy goods and services, right? For consumption or for resale. So this one would be used so which method will then so which method will we use when we want to calculate GDP at market price? The expenditure method, because the market price is the prices that we pay when you want to when you want to buy goods and services for consumption, right? Yeah, I don't know if you guys, but you can just read this here and then try to know it. But that's how I do it. Then for basic prices, obviously it's the method that is left, which is the production method or the value added method, right? So for GDP at factor cost, I'm like, which method am I gonna use? Then I remember, okay, factor cost, those are the factors of production. The factors of production, they do what? They earn income, right? For their factors. So obviously it means now if they're saying GDP at factor cost, I'm gonna use the income method, right? Calculate GDP at market price. Which method am I gonna use? Because it's market prices, we usually pay the market price when we spend on goods and services for consumption, right? So I'm definitely gonna use the expenditure method for this one. So obviously the basic price is now I'm gonna use the method which is left, which is the production method. And then measurement at market prices, basic prices, and factor cost. So basically, okay, let's just look at this side. So here they say if you have GDP at factor cost and you want to calculate GDP at basic prices, you're going to say plus taxes on production minus subsidies on production. You're going to get GDP at basic prices, right? So this is the outputs still in the factory, right? This is the output still in the factory because it's GDP at factor cost. So the output's in the factory. And then they're going to add taxes on production because they're still in the factory, minus subsidies on production because this is still in the factory, right? It's the factor cost. You're gonna get GDP at basic prices. So basic prices, why? Because these prices do not include any taxes and subsidies, right? So now these goods they leave from the factory to the shops, right? And when they get to the shop, they are at basic prices. Then the shops they do what? They add taxes on these products and minus subsidies on these products if some of the products are subsidized. Remember, government can subsidize some of the products such as bread. You find out, Suguti, the price we're supposed to pay for bread is not the price that we're actually paying. The government is also paying some amount, right? That is a subsidy on products plus taxes on products, obviously. And then you get what? GDP at market price. Now, this is the price that me and you, when we get to the shop, that we are going to pay, right? So this one going down, it makes sense to me. So now, if I need to calculate GDP at market price, I just now do the opposite because when I was going down, I added taxes on products and I separated subsidies on products. So now, if I want to now go up, obviously to get the now to get the GDP at basic prices, it means I'm gonna say GDP at market price plus subsidies on products minus tax on product to get this one. Right. Again, now if I want to get GDP at factor cost, I'm gonna say GDP at basic prices plus subsidies on production minus taxes on production to get GDP at factor cost. So you can either no, like okay, I prefer to know this one because with this one you can just go down and up again and it makes sense, guys. Can you see? Because GDP at factor cost, these are the products when they are still in the factory, right? So the products are still in the factory. Obviously, you're gonna add taxes on production, right? Because you are charged taxes on this production, right? You're charged tax by the government. Minus subsidies on production, that's if the government subsidize your products, right? And then you're going to get GDP at basic prices. These basic prices, this is where now the products they move from the factory to the shop, right? When they get there to the shop, they are at basic prices because they are exclusive of taxes, which is like VAT, and also of subsidies, right? So when they get there to the shop now, you add what? Taxes on these products and you separate the subsidies on this product to get what? The GDP at market price. Now, this is the price that me and you are going to pay when we get there. So now to go back, you just do the opposite. Also get this side. And then here they're saying that GDP at constant prices is equal to real GDP. Obviously better because to calculate real GDP, you use the constant prices. And then in the base year, real GDP is equal to nominal GDP. This is also true because in the base year, Um, let's say, remember when you're calculating real GDP, you use the you use the prices for the base year, right? So let's say you are calculating okay, let's say you are calculating real GDP for 2010, right? And you bought two quantities of bread and and the price was 10 rand. So you're gonna say 2 times 10 for real GDP. So in the so in the base year, the real GDP will be equal to nominal GDP because why you are using the same figures. So remember, let's say 2010 is our base year, right? And we have and the bread, you buy two quantities of bread for 10 rand, right? 10 rand each. So you're gonna say 2 times 10, you're gonna get 20. Also, the nominal GDP is going to be 2 times 10, which is 20 because it's in the base year. If they say, let's say now we are in 2025, right? And they say calculate real GDP and nominal GDP for 2025 using 2025 as the base year. So it means that you're going to use the quantities for 2025 and the price for 2025 for real GDP. And also for nominal GDP, you're going to use the quantities for 2025 and the price for 2025, right? So in the base year, the real GDP is equal to nominal GDP because you're using the same figures, right? Or GDP at constant price is equal to GDP at current prices. Yes, obviously because you're using the same market price and the same um constant price. And so, okay, it's just they're just showing you here, Guti, GDP was the same here in 2005. Um, You have gross national income and gross national product, right? These words can be used interchangeably, gross national income and gross national product. So to calculate gross national income or gross national product, you just say GDP minus all income earned in South Africa by the foreign factors of production, plus all income earned by South African factors of production in the rest of the world. Basically here, we're just trying to find out the income earned by all South African citizens, right? In order to determine their standard of living, how much income are they earning, right? So we're gonna say GDP minus all the income earned by people who are in South Africa but are not South Africans, right? We minus that one. But we're gonna add the one which is earned by South African citizens, even the ones which are in the rest of the world, right? Even the people that are working in USA. Even the people that are working in USA, right, we're gonna add their income as long as they are South African citizens, right? To get that one. And then GDP is equal to expenditure on GDP. Okay, this one is GDP using the expenditure method. Obviously, we said it's the consumption um of all the participants in the economy, which is consumption by households, by firms, by the government, and then also consumption which occurs with the rest of the world, right? In the foreign sector, which is through exports and imports, that X minus Z. Then also have gross domestic expenditure. So gross domestic expenditure, it's basically now we just want to look at the expenditure within the economy, right? What we spend inside South Africa, not with the rest of the world, right? You can see here we just say C plus I plus G. We do not include the interaction with the foreign sector, right? Which is exports and imports. We exclude them. While when we are calculating GDP, we also include our exports and what's in our imports, right? But GDE is just domestic expenditure, right? Domestic expenditure, meaning that spending in South Africa only, right? So they're saying that exports excluded in the GDE because expenditure occurs in the rest of the world, while imports included in the GDE because expenditure occurs in SA. So you have to know basically here is how to calculate GDE. You just say C plus I plus G. You don't include exports and imports. But now GDP, you include exports and imports. Relationship between GDE and GDP. It's just that with GDE, you do not include exports and imports, but with GDP, you include imports and exports. So if you if your GDP is greater than your GDE, then you have a positive balance of payment. It's what we've been saying. Here, this means that if your export is greater than your import. Remember I said that your export is like your income because you are selling to the rest of the world, so they're gonna pay you money, which is going to be an income. And then your imports, it's like you are buying from them, so you pay money. So it's like an expense. So if the income is greater than the expense, then it means that you will have a positive balance. But now, if our expenses are greater than our income, then we have a negative balance. That is when our GDP is less than our GDE, right? Um, then you have okay, let's recap. 3 approaches to calculate GDP. You know them. We have the income method, expenditure method, and you also have the production or value added method, right? The 4 major sectors in the economy, you know the 4 major sectors. You have your households, you have your firms, your government, and your foreign sector, right? And the element of total spending. The elements of total spending are the ones which are there in your expenditure method, right? Which is C plus I plus G plus X minus Z. Those are the elements of total spending, right? Okay, now let's do these questions. They're saying that using the expenditure approach computes GDP. Remember, how do we calculate GDP using the expenditure approach? We say we basically add all the expenditures of the participants in the economy, which is C plus I plus G plus X plus C plus I plus G plus open brackets X minus Z. So we're going to say um consumption by households, which is C, which is 65 7,3 plus investment I, consumption of face capital. In the expenditure method, it is added as investment. And then in the income method, it is also um added as depreciation, right? So don't be confused when you see this in the income method and also you see it being added in the expenditure method, right? Because these are our fixed capital fixed consumption of fixed capital. It's basically relates to the purchase of equipment, right, of capital goods. But we know that those equipment's value, it's an investment, right? Because we're purchasing equipment which we are going to use. It's an investment. But those equipments, they do what? At the end of the day, they depreciate, right? So which is why we add this amount in when we are calculating our expenditure method because we spend money on buying these equipments. And also we add it on the income method because um on the income, we add it on the expenditure method because we spent money on acquiring this equipment, and we also add it on the income method as depreciation, right? So we're going to add here, and I said it's personal consumption expenditure, this one, which is 657.3 plus 35.4, which is consumption of first capital. Then we're also going to add net private domestic investment, which is part of investment as well. And then it's C plus I plus G, government. We're also going to add government purchases, which is 178.2. And then we're going to add your exports. So you open your brackets, you add your exports. Exports 53.4 minus